Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Thanks for being with us today. We're talking about retail and retail real estate. We have Ryan Severino with us, senior economist with REIS. And Ryan, let's talk about the investment market. In 2014, what was sales volume like? It seemed like in our shop that activity really picked up for retail properties.
Well, yeah, I would say, we still don't have final volumes due to those, those pesky non-disclosure states, but I can tell you that based on how the market has been behaving and how fourth quarters usually behave and what I've seen from our preliminary data, it definitely looks like transaction volume last year will set a post-recession high. We'll probably be for individual property sales somewhere in the $25 to $35 billion range, depending upon just how strong the fourth quarter was. And that would really be the highest volume that we've seen since 2007. And if you remember, in 2007, retail really was the darling of commercial real estate. That was the most favored property type coming out of the last recession before the most recent one that we went through. So things are clearly trending up over time if we're starting to see transaction volumes nudge back toward those pre-recessionary levels.
Okay. And, you would think with the job market improving, you've got these gas prices coming down, you have more consumer spending that people will be more interested in buying retail real estate, but I guess it still has some volatility too. So how is that impacting cap rates in 2014 for retail? What did you see?
Cap rates last year were generally trending downward for all of the major subsectors, and I think you hit the nail on the head that consumer spending is slowly increasing along with the recovery in the economy, the recovery in the labor market, the fact that in the latter half of the year we did probably get a little bit of a boost from the decline in energy prices. So I do think we are seeing interest in retail slowly recover. But as I mentioned with fundamentals, it is a multi-speed recovery. There are definitely certain pockets of the market that have been performing better than others. So I would say we've seen relatively better performance from kind of the extremes of the market, sort of the very sort of bottom defensive non-discretionary segment of the market's been holding up really well, and then the sort of more affluent luxury high end of the market's been holding up really well. The middle of the market, we haven't seen as much compression because, again, that's where we're still searching for demand to come back, where we're still seeing a lot of households struggle with weak income growth, where we haven't seen a lot of discretionary spending on their part, or at least not as much as we would see in a healthier economic environment. So I would say it's to a large extent, it's reflective of what we're seeing on the fundamental side.
Okay. And if you will, Ryan, give us some sample cap rates for some various property types or areas.
Sure. So if you're talking about neighborhood and community centers overall, you're looking at cap rates somewhere in the kind of 7.5% range, give or take, maybe 20 or 30 bips on each side of that. For the malls, it really depends on the caliber of the mall because right now, as I mentioned, there's still that huge disparity in performance. So if we're talking about Class A malls, the cap rates right now are going off, 5%, maybe even lower is not completely unheard of because there are relatively few of those malls. They don't trade all that frequently, and demand tends to be pretty robust these days when a higher-end center does actually come up for sale in the marketplace. But for those kind of Class B and lower caliber malls, I've actually seen some deals going off at high single-digit cap rates, if not actually low double-digit cap rates. So it's heavily dependent upon the quality of the mall that's being traded, where it's physically located, and if there's some kind of story around that individual center that needs to be taken into account for a sale.
Right. Yeah, that's a good point. I know on the show we talk a lot about cap rates, but our show listener is very fluent and experienced, and they always understand that look at every property independently because the strength of the tenant and a lot of factors are going to impact the cap rate and the value of those properties. But having said that, so cap rates have been trending down on some of these properties. What do you expect in 2015? Do you expect that to continue?
Yeah, I do. I wouldn't expect to see as much cap rate compression this year as we've seen over the last few years. I think the majority of cap rate compression is probably in the rearview mirror at this juncture. But that said, I do expect to see cap rates generally trending slightly downward for neighborhood and community centers, maybe another 10 to 30 basis points overall, with some of the stronger centers outperforming that expectation a little bit. For the mall sector, I think, depending upon which properties actually come up to trade, we could see some decent movement depending upon the composition, because there is still a lot of demand for high-end centers out there relative to the supply that could potentially come online. I think for those kind of, Class B plus and lower caliber centers, it's really going to depend on the mix of centers, because I think there are some centers that are out there where the impairment that they're going through is probably a little more temporary, and there's still some room for cap rate compression there. The ones that are having issues that are a little more permanent, probably not so much. And so I think overall we expect this to be another year for probably modestly declining cap rates, but I don't expect an outright increase in cap rates this year.
Okay. And do you expect new construction to have any impact on the investment market?
I really don't at this point. There's still so little new supply that's coming online in the market this year that it's probably going to have a systematically insignificant impact on the market. Now, that said, as you just mentioned, especially with retail, so much of retail, I think even more than other major commercial property types, is very property specific. Where it's located, what its trade area is like, who does it compete with. And I think there will probably be some centers this year, here and there, that dot the landscape that will have to bear the brunt of a new center coming online. Because I think the one dynamic that I have seen when there's been new construction, and this is more the exception than the rule, so I don't want to overstate the prevalence with which I'm seeing this, but there are some a little more risk-seeking entrepreneurs that are going into areas where the retail is a little bit tired, if you will, and they're coming in and saying, look, I know that there are high vacancy rates in this market, but these centers are not the sexiest centers that I've ever seen. I can build something new, offer the existing tenants in a whole bunch of other places, probably attractive rents to sell them at the depressed market, and snatch those away. And so I think that could have an impact, because it becomes a glorified game of musical chairs. There isn't necessarily enough demand to satisfy all of the inventory in the market, but if the newer, sexier properties can steal tenants away from some of the older ones, that could certainly have a deleterious impact on existing inventory and values in the marketplace.
And that's interesting to hear you say that, because it seems like we're seeing some of the retailers, some of the larger ones, start to dip their toe in the water for expansion and opening new stores.
Yeah, it's definitely a mixed bag. I think there are some retailers that are out there that, the times are starting to get better again, and they're changing their expectations for the future, while we still are seeing some that are closing stores and rethinking their strategy. But, overall, I think the trend is positive. I think net absorption should be positive over time. So I think the good is going to outweigh the bad going forward.
How about some tips for investors?
I think the one thing I would say is be wary of the siren song of those seductively high cap rates. I'm not saying to never do those deals, but it's important to understand where that high cap rate is coming from, whether it's some cyclical or temporary impairment. And I mention that because as retail has slowly come back, my phone, when it rings, I think increasingly more people want to talk about some of these centers. And I'm just reminding investors, make sure that you understand whether it's a temporary or permanent impairment in the center, because there's always a reason why cap rates are high, and investors need to understand what's causing those high cap rates.
Well, that's well said and a good point. And I think there are opportunities in these value-add centers, especially in a lot of the markets that we're looking at. Ryan, thanks for joining us today. We appreciate you being with us.
My pleasure as always, Michael. Thank you very much.
Well, stay tuned. We'll have more on retail and retail real estate. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's REALNEX. FIU, Florida International University. Earn your master's in real estate in as little as 10 months without interrupting your career. Visit FIUonline.com. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit CREshow.com.